So books are being written right now. Finance books are being rewritten, economics books are being rewritten because of negative interest rate policy. About 25% of the globe is under negative interest rate policy right now, and it's horrible for financial institutions, and it's horrible for savers. People in Japan and in Europe are experiencing negative interest rates. Negative interest rates, and you may want to write this down because this is what's going to be on the test, right? And to be able to supplement what you wrote before so that you can come back in and write it again, you'll do a better job. Okay, this is really, really important, so you want to write this down or you want to record it. So negative interest rates will drive down currencies in the short run, which will cause your exports to be cheaper in the trade markets. That's usually why they do it. But the problem is it's affecting the banking institutions and it's affecting savers and investors. Go for it.
Can you say one more time what happens when there's negative interest rates?
We don't. It's never been done before.
Like what happens?
We don't know. The first thing that happened was it devalued the currency, okay, which caused the exports to be cheaper, okay, which they were trying to grow their way out of a recession, and they were trying to create inflation in the economy through negative interest rates. But the problem is that financial institutions buy government bonds, and if they buy government bonds at negative yields, then it eats into their profit margins. It eats into their interest margin, and it causes their stock price to go down. Since savers are getting so little interest on their deposits, they're hoarding cash. And because they're getting such little interest on their deposits, if you net the fees, they're actually paying the bank to hold their money. This has never been done before in history. So we do not know the long-term implications, but if you look at Japan and if you look at Europe, the outcomes don't look good. And the United States, under Yellen, is looking at negative interest rate policy. That's why I ask it, that's why I put it on there. Okay, so just imagine a negative risk-free rate. Okay, never in history have we seen negative risk-free rates. So imagine negative risk-free rates. 10-year treasury yield is what, 1.77? 7.6. Imagine if you saw a 10-year treasury go negative or zero. At a negative or zero interest rate, what's inflation expectations? Zero or negative. Okay. And what does that tell you about the economy? If you have an inverted curve and your inflation expectations are negative, what does that tell you about future economic growth?
They're about to have a recession.
Recession, exactly. So these are just the dynamics. You know, it's all recent that this has happened, and the books don't reflect a lot of this stuff. And if you think about the financial models that you're using right now, it kind of distorts the system. Okay, it really distorts the system. And the Federal Reserve probably should have raised interest rates a long time ago. They didn't. They held it at zero interest rate policy, and we have just massive distortions in the economy right now. Okay, which could lead to financial crises or other types of distortions. And the Fed doesn't have the policy tools anymore to really lower interest rates to stimulate the economy. They'll have to go negative or use other types of monetary policy. So it's just a reality that we're looking at. We talked about yield curves and yield curve dynamics. The importance of yield curves in determining the risk-free rates and the shapes of the curves and the shifting of the curves. Because at the end of the day, it's the risk-free rate. And the risk-free rate is embedded in the risk premium approach and the capital asset pricing model. So any movements in the, or shifts or movements in the yield curves will have a direct effect on the risk-free rates, which will have a direct effect on the cost of the debt and the cost of the equity for the firm, and the weighted average cost of capital. So all debt, all equity, all real estate are priced off of the yield curve. And they're all embedded in the cost of debt. Then I want you to put in the cost of debt equation, capital asset pricing model, I want you to put in there, and then the weighted average cost of capital calculations. And then show me the intrinsic valuation equations. Dynamic yield curves, really, really important. We know that when the curve inverts, the stock market peaks, and we go into a recession in 24 months. So again, just reinforcing those ideas. Modern portfolio theory, the really key to this And show as much detail as possible. Really try to show me those graphs. Okay, don't use the curve all, contorted, make it look like an umbrella. Have the capital allocation line go up. Show me the lines that go to 100% stock portfolio and 100% bond portfolio. Show me the utility curves, and that when the utility curve, is tangent to the capital allocation line in efficient frontier, that's the market basket, and gives you the highest risk-adjusted rate of return. Okay? But the key here is you have to show me if you add alternative assets to your stock bond portfolio, that it bows out the efficient frontier. So you have to, a lot of you didn't show me the bowing out of the efficient frontier, and you didn't draw in the lines to show me that the reduction in the expected rate of return on the portfolio was overcompensated by the reduction in the portfolio standard deviation. Therefore, since the reduction in portfolio standard deviation was more than the reduction in the expected return on the portfolio, the risk-adjusted rate of return went up. Therefore, you should include alternative assets in your multi-asset stock bond portfolio. You need to show me too in a table what the target in the model portfolio looks like, okay? Because this is the allocation that is going to be recommended by you over the next 30 years to institutional and accredited investors. And it's going to be 40% bonds, 30% stock. It's going to be 10% cash value life insurance. It's going to be 10% direct private equity real estate. And it's going to be 10% alternative renewable energy assets, infrastructure. So that's really what I'm looking for in that analysis, and make sure that you really understand. Intrinsic valuation, what's the perpetuity model? I get this all the time, it's really amazing. In all of my classes, it's the same thing. I ask them what the perpetuity model, and they don't know what it is. I don't hear anything. So what's the perpetuity model? Perpetuity model. And this will probably be on the exam on the final, because again, I'm not convinced yet that you understand what these intrinsic valuation models are and that you burn them into your brain. So what's the perpetuity model?
Cash flow over I for interest rate?
I would not use interest rate, okay? It's the cash flow, but is it last year's cash flow, this year's cash flow, and next year's cash flow? Is it the cash flow that we're using to do the valuation, is it last year's cash flow, this year's cash flow, or next year's cash flow? Next year's cash flow. Everybody needs to know this, okay? Please, please, please memorize this. It's going to be in the interviews. They're going to assume you know this stuff, okay? Next year's cash flow, and then you're going to divide it by what?
The risk-free rate?
You would divide it by the risk-free rate if you were valuing what?
Bonds?
What type of bonds?
Treasury bonds.
10-year treasuries. Yeah. Would they be perpetuity bonds that would pay forever? Or do they pay a coupon and then a principal on the back end?
Coupon and the principal.
What?
Coupon and the principal on the back end?
No, because that's not in the equation.
It's a cost of capital minus the long-term growth rate, right?
That's the, what model's that?
Gordon Grove?
That's Gordon Grove.
Oh.
Okay. So, listen, the perpetuity model, you're going to use the cash flow, okay, next year's cash flow, divided by the expected return. Expected return could be the interest rate. Expected return on the bond, if you're doing a corporate bond, could you use the risk premium approach to calculating the bond yields, which you can use to apply to the cash flow to get the value. You can use the expected return. You could also use the capital asset pricing model to take the earnings per share and divide it by the CAPM calculation for the expected return on the equity. You could do that too. The model is basically fundamental, but you could swap out the numerator and the denominator depending on what you're trying to measure. But the equation is very simplistic. The question is, what are you trying to value? What are you trying to value? Trying to value a terminal value? Well, we know that we have to grow the cash flow out one more period, and then we can apply the perpetuity model or Gordon growth to get the terminal value to add back to the last year in the holding period. So we use perpetuity and Gordon growth in multiple ways to to do the valuations, depending on what model you're using. In the Gordon Growth, tell me about Gordon Growth. What's the Gordon Growth model?
Cash flow or IISG
Yeah, and are we gonna use last year's, this year's, and next year's cash flows?
next year.
Next year's cash flows. And then what do you wanna use for the I? What are the definitions of I? What could the definition of I be? What would I be?
Risk-free plus beta,
What equation is that?
that is,
And tell me through the whole equation. Tell me what the capital asset pricing model is. Let's say I'm trying to value a stock using earnings per share for next year. And for the expected return on the equity, I want to use the capital asset pricing model. What's the capital asset pricing model? What's the capital asset pricing model? Either you know it and you're not saying it, or you don't know it. So in both situations, I'm a little concerned. So tell me, do you know it and you're not saying it, or is it you just don't know it?
So risk-free rate plus beta times the expected market return plus the risk-free rate.
Is it plus the risk-free rate or minus the risk-free rate?
Minus.
Minus the risk-free rate. Thank you very much. I appreciate that. Yeah, CAPM is extremely important. Okay, it's extremely important. Okay. Tell me about G. What is G? What is G? In what?
next year's, EPS.
Is that true? When you're using the Gordon Growth Model, is G next year's EPS growth rate?
Cash flow.
Is it next year's? Is the G in the Gordon Growth model next year's growth in earnings per share?
What's the earning expectations cash flow at a constant rate?
Excellent. So did everybody hear that? Can you say that again, please?
The earnings expectation cash flows grow at a constant rate.
Yeah, so it's a constant growth rate over time forever. So basically, it's just like the perpetuity model, but it's a constant growth rate in the earnings per share. So for,
But it's the projected, right?
yeah, it's projected, it's expected growth rate in the earnings per share forever.
Okay.
So for high-tech firms that are, rapidly growing, you probably use a higher growth rate to get a higher valuation.
Yeah.
But in stabilized companies that have been around a long time, that are very mature in their marketplace, you're probably gonna use lower growth rates. So it's the expectation of the ability of the firm to grow the earnings per share out per year forever at some average rate. Okay, all right, nice job. Tell me about the multiple approach.
Cash flow times M.
Yeah, and what cash flow are we gonna use? Last year, this year, next year?
Next year.
Next year, okay, and then how do we calculate, give me 3 ways of calculating the multiple. Give me 3 ways of calculating the multiple. P over E, or what's that also called?
Price to earnings ratio?
Yeah, it's a price to earnings ratio, which is also called the PE multiple, okay? For accuracy purposes, do we want to use last year, this year, or next year's PE multiple to get the value of the stock? Do you want to use last year's multiple, this year's multiple, or next year's multiple?
Next year.
Next year, you want to use a forward-looking multiple. Excellent. And then give me 2 other examples of multiples that you can calculate.
I over R.
What is it?
I over R.
No, that's not
One over
right.
I,
What is it?
one over I.
Yeah, it's 1 over I. So make sure you change that. Yeah, it's 1 over I. So that's going to give you a multiple. And under that multiple scenario, do you assume that the cash flows are going to be constant forever or grow at a constant rate? Are they going to be flat forever or grow at a constant rate with 1 divided by I?
And they're growing at a constant rate.
Anybody else? If you take 1 divided by I, does that assume that the cash flows are gonna remain flat forever or grow at a constant rate?
Constant rate.
Are they gonna grow at a constant rate or remain flat? 1 divided by I.
They'll remain flat.
They're gonna remain flat forever. It's basically the perpetuity model, but you're just manufacturing a multiple by taking 1 minus I. Okay, it's the exact same outcome, okay? And then if you were to assume that the cash flows were gonna grow at a constant rate forever, what model would you use?
I over R minus G?
Yeah.
1 over R minus G.
1 over R minus, 1 over I minus G. 1 over I minus G. So make those corrections. 1 over I minus G.
That's
So
gross.
you're basically using the Gordon growth model, okay? And then the assumption under 1 divided by I minus G, are you assuming that the cash flows are gonna remain flat forever or grow at a constant rate? Grow at a constant rate, okay, excellent. So that's the multiple model, all right? And then the discounted cash flow model, maybe you can walk me through the steps. What would you do if you were to discount a series of cash flows? So walk me through what if you were asked to do a discounted cash flow of a stock or a company or a piece of real estate, what would be the steps that you would go through?
Present value equals cash flow the first year, plus, or over 1 plus I, plus the cash flow the next year, over 1 plus I squared,
Yeah, so you grow out the cash flows,
and then add terminal value,
and then you're gonna, how do you get the terminal value?
grow 1 more year.
You grow it out 1 more year, and then what do you apply to it? Or what can you apply to it?
Perpetuity or.
Yeah, you can apply the perpetuity or the Gordon growth. Can I apply a multiple to it? Yeah, I can do that too to get the value. If I use the Gordon growth model, is the present value gonna be higher or lower? If I use Gordon growth as opposed to perpetuity to get the terminal value, is the present value gonna be higher or lower? It's gonna be higher. Is the net present value gonna be higher or lower? Higher. Is the internal rate of return gonna be higher or lower? Higher, okay. So you need to, I'm kind of grilling you and drilling you on kind of the fundamentals. Because again, when you're in the interviewing process, they're gonna be asking you this stuff on the fundamental level, okay? And then what do we do with those cash flows? What do we do with the terminal value?
You add it back to the last value?
Excellent, you add it to the last period in the holding period. Okay, so you bring it back. And then what do we do?
Add them all together?
Yeah, well, don't we have to do something first to the cash flows? We've already grown them out. We've already calculated the terminal value.
Divide them by the,
What do you divide them by? You want to write these down, discount factor, the appropriate discount factors. Once you divided the cash flows by the discount factors, what do you get? What do you get? You get the cash flows, you divide them by the discount factors, what are you gonna get? What's the product? You got the cash flows, you calculate the discount factors, you discount the cash flows, you sum them up to give you
present value.
present value, get the present value. Okay? And if you subtract out the acquisition cost or the cost of construction or the cost of development and you get a negative net present value, do you accept or reject the project?
Reject.
You reject it. And if you really want the project, what would you do? What?
Equal out. Net present value equal.
If I got a negative net present value and I really want the project, but I don't want to reject it, I want to accept it, what would I do?
You want it to equal
Check
cost.
it.
What?
You want it to equal cost or zero.
No.
Check your calculations.
No, you're going to step 2 or step 3. What do we do if the negative net, if the net present value is negative, okay? Do you accept or reject it?
Reject.
You reject it, but we really want the project. So what's the first thing you would do?
Revalidate the scope.
No.
You could change your expected rate of
No,
return.
not yet. You have to go through the steps, okay? So we reject it, we get a negative net present value, what do we do next? If we really want the project.
Reduce cost or price.
Exactly, you would reduce the acquisition price, or you would reduce the cost of development by how much? By how much?
The difference from zero.
Or it could be zero,
What?
the amount they get it to zero.
That's right. You would reduce the cost or the acquisition price by the amount of the negative net present value. Thank you. Then, if your negative net present value, if you still get a negative net present value, then what do?
Recalculate,
Go for it.
recalculate all the numbers.
Yeah, you go back and you audit all your assumptions, right? And then what would be those assumptions that we would reevaluate?
Growth rate.
Yeah, the growth rate and the cash flows.
Discount rates.
We would go back and maybe, reforecast out the forward curve on the risk-free rate and then go back and recalculate, the risk premium approach to the cost of the debt, go back and review the capital asset pricing model, see if we overestimated the return on the market or the beta, yeah, and then recalculate the discount rate. Maybe we have too high of a discount rate. And what about the growth rates and the cash flows? If I'm getting a negative net present value, am I over or underestimating the growth rate in the cash flows? Over or underestimating the growth rate?
Underestimating. Underestimating.
Underestimating the growth rate in the cash flows. Okay, go ahead, sorry.
I was gonna ask, like, I got it now.
Okay. And then what other components of the discounted cash flow model would we need to audit? Because we've already gone through the growth rate and the cash flows. We've already gone through the
Terminal value.
discount rate. Which one?
Terminal value.
Terminal value, okay. And what do you want to assume? Or were we assuming using the perpetuity model or the Gordon growth model? Okay, so if we use Gordon growth to get the terminal value, what two variables in the model where we may have made some mistakes?
ING.
What?
ING.
ING, okay, so did we over or underestimate I?
Under.
Now, if I'm getting a negative net present
Over.
value,
Over.
I'm overestimating the I. And am I over or underestimating the G?
Underestimating.
Underestimating the G, okay, that was good. Whew. That's a lot. We'll go over and over and over again, because you gotta have this stuff in your head.
So when you add in some like the risk premiums and stuff that change your
That's true
I
too.
value, right?
That's true too.
So those are things that you could have overestimated
Yeah,
as
we
well.
could have overestimated the terminal discount rate that we were using in the Gordon growth to get the terminal value. That's true too. Nice job. Okay, and then let's just walk through one more time, because I'm not going to go through it because I want to go through the presentations. But I went through. This is already posted. You were emailed. You were notified, so you already have this stuff. So there's nothing crazy here. But I will walk you through the logic here. So I already gave you a lot of the information. So when you calculate the multiple approach, you can use a 12% expected return to get the multiple. Free cash flow, this is the investment banking, we're buying a technology company. So you have the free cash flow, and we're going to use EBITDA. And last year, the EBITDA was $200 million. Free cash flow growth rate, well, the going in growth rate using the Gordon growth. And I would go ahead and do the calculations using the other approaches. So you're going to do a DCF approach, but you're also going to use perpetuity and Gordon growth. So what you want to do is you want to grow out the EBITDA in t equals 0 to t plus 1 more year. And I already give you the growth rates. And then what you'll do is you'll apply the discount rate. So on the Gordon growth model, using current numbers, you would use a growth rate of 5. And then on the terminal value for using Gordon growth for the discounted cash flow, you would use 3. Okay, so there's two. You got to know where to apply the numbers. Right? The weighted average cost of capital or the discount rate. You have a capital structure of 70% debt, 30% owner's equity, you have going in weighted average cost of capital of 22%, and you have a terminal weighted average cost of capital of 24%. So when you're calculating the terminal value at the end of the discount period, you're gonna use a 24% discount rate. And you're gonna use a 3% growth rate. Okay, so you might wanna take some notes on this, so that you're not guessing. So we also did a pro forma cash flow on the growth rates in the EBITDA. So from 0 to 1, they were projecting 20% increase in the EBITDA for the first year, which is gonna be the first year in your discounted cash flow calculation. And it's gonna be the cash flow that you use to apply the perpetuity model and the Gordon growth. So I'm adding in 2 more valuation steps. Okay. And remember, for the Gordon growth, if we're using the EBITDA in t equals 0, so we're gonna grow this out by 20%, and then we're gonna divide that by the 22% whack.
So like for when we've done it, we did it for what it
And we didn't, we've done the perpetuity and the Gordon growth before, just in practice, but we haven't applied it to an actual case study.
Okay. No, I was gonna ask, like, so like for year 1, instead of being 200 million, it'd be the 200 million times that 20%,
1.2.
or 1.2%.
That's right.
Okay.
And that's gonna be your first year
And
in the discounted cash flow model. And it's gonna be the cash flow that you're gonna use to apply the going in discount rate to get the perpetuity valuation. And you're gonna use 22% minus the 5%, okay, to apply to that 200 million times 1.2 to get the Gordon growth valuation. So you're doing 3
okay.
valuations here. Okay. All right, so here's your growth rates for year 5, all the way out to year 6. So it's a 5-year holding period. Okay. The target company acquisition price is $4 billion, which is totally reasonable these days, you know, in technology investment banking. So using perpetuity, Gordon growth, and multiple, what is the intrinsic value of the target company? Okay, so first I'm asking you, do you know how to do perpetuity, Gordon growth, and multiple? Okay, and again, I'm going to tell you right now, so you may want to write these notes down to make it easier for you to do the calculations. So you're going to grow out the 200,000 by 20%. 1.2. You're going to get that cash flow, and then using the perpetuity model, you're going to divide it by the weighted average cost of capital, which is 22%, so 0.22. For the Gordon growth model, you're going to grow out the 200,000 by 20%, get the cash flow. You're going to take the going in whack, which is your expected return, minus the going in Gordon growth, or the growth rate, to get the denominator that you're going to use to get the Gordon growth valuation. Okay. And then for the multiple approach, what I would do, basically show me that the multiple approach is basically the same. Okay. If you do 1 divided by whack, or 1 divided by whack minus the growth rate, you're going to get multiples. I didn't give you a PE multiple here, but if you can show me how to calculate the multiples, and then apply it to that 200 million times the 1.1, the T plus 1 cash flow, to show me the valuation, then now you're really starting to learn this stuff the right way. Because you can do perpetuity, Gordon growth, and then do DCF. And then I want to see the DCF calculation. Okay, so 1, 2, 3, 4, 5 cash flows. You're going to grow them out. You're going to grow it out 1 more year at the end to get that 6th period. Then go ahead and use the Gordon growth model. You have a weighted average cost of capital, terminal WACC you have a terminal G of 3, so it's basically 0.21. So that 6th period cash flow, you're going to divide by 0.21. Because they gave you both going in and terminal growth rates and discount rates. So that way you're going to get the terminal value, you add that to the 5th year of the holding period. Your discount rate is going to be 22%. So you're going to have to multiply and get the discount factors to then discount those cash flows to the present and give me the present value. The net present value, you can estimate the IRR and then the break-even period. How long would it take to recoup the acquisition price from the cash flows over a period? Just, just throw those in there, just to try to do the calculations. And then would you accept or reject the project? If the NPV is negative, what iterations would you go through? We already talked about that. If the net present value is negative, what would you do? Let's go through it again. What? If the NPV was negative, the first thing you would do is,
Reduce cost.
if you want it,
Reduce costs.
reduce the cost of the price, okay? And if you can't do that,
Recheck your calculations.
recheck your calculations, and if you can't do that, you calculate the real call option. And what does the real call option value need to be to get to accept this project?
Positive.
What?
Positive. Even.
0 or
Yeah.
positive?
Zero.
0 positive, yeah, exactly. So your net present value needs to be 0. And if it is, then you accept or reject the project? Accept it.
It can be either or, right?
Yeah, it could either be positive, the net present value could be positive, which you would accept. And if the value of the real call option is equal to the negative net present value, your net present value is 0,
Yeah.
and you accept it.
Okay.
All right. Now, if you can get this here in, you got it. Okay, so basically it's the same approach. This is the real estate development down in Mission Bay. So we're using net operating income, not EBITDA in this case. We have cash flows from the last year. For the perpetuity, or for the Gordon growth model, we have the going in G, and to get the terminal value, we're using 1%. And we're gonna use Gordon growth, or about the terminal value. We have gross potential rental income of $150 million. We have the return on the investment by the client is 12% going in, and for the terminal value, they're gonna use 14%. Okay. The pro forma cash flows, we're gonna use net operating income. It's gonna grow at 10, 8, 5, 2, 2, and 1. This is a pretty big project. It's about $125 billion. And again, it's a 5-year holding period. And you go through the same decision-making process. Okay. And then the last one is a stock. And I was thinking on that one, it's like an Intel or an IBM stock. So we already know that last year's earnings per share was $13. If we're going to use the Gordon growth model to get the valuation today, we're going to use a growth rate of 1%, and we're using a growth rate of 1% to get the terminal value too. Because we're going to assume we're going to use the Gordon growth. Yes, sir.
Quick question on the last case study, where does that 150 million of rental income come in again?
I just threw that in to kind of confuse you. No, that was basically just a plug to confuse you. What you would normally do is you would take the gross potential rental income, take out vacancy rate, add back, or take out some concessions, and add back other income to get the gross effective rental income. And then you would take out expenses to get the NOI. I didn't want to do that because it was too confusing, but I thought I'd throw it in just to confuse you. So you're going to use net operating income, but nice catch. I'm giving away all my cards. share for last year at $13. When we use Gordon growth to do the valuation, we're gonna use 1% going in, we're gonna use 1% on the terminal. You have the growth rates for the earnings per share, 5%, 5, 4, 3, 2, and 1 for the next 6 years. The current stock price is $157, and you're using a 5-year holding period. What's the intrinsic value of the stock, and show the intrinsic valuation weighted average calculations. So, you know, perpetuity, Gordon growth, multiple, DCF. If you were asked to give 3 weighting scenarios, what would they be? So give me 3 weighting scenarios, like we did last time.
So like the 11X, well,
Well, we were using, what, 10% to perpetuity, 10% to
oh, okay.
Gordon growth, we were using 50% for DCF, and then we were using the balance, you know, for the multiple. I don't have a multiple here, actually. Should probably add one. Can I calculate a multiple from the data that I have here? Can I calculate a multiple? Yeah. Could I use a Gordon growth or a perpetuity model? You know, 1 divided by I or 1 divided by I minus G to get a multiple, and apply that to the T plus 1 earnings per share to get a valuation?
Yeah.
You would do that. And would the approach be the same? Would the results be the same? Yeah, they would be the same. Okay. So what weighting scenarios would you use? And why did you choose those weights? Again, did you understand that the DCF and the multiple approach were the most important valuation methodologies? And basically the multiple approach, you know, 1 divided by perpetuity or 1 divided by Gordon growth is basically the multiple approach. So multiple in DCF. And DCF is the most important, but multiple is the most used. Okay. What is the premium of the final intrinsic value above the current stock price? Is it within a reasonable probable range? So do you know that when you calculate the weighted average value from those 4 approaches, you divide the intrinsic value by the stock price, you're going to get a premium. It needs to be within 20%. If you're over 20%, you're probably overvaluing the stock. So is your valuation reasonable when compared to the current stock price? That's basically what I was trying to get there. And then what are your trade recommendations? Well, it's either buy or sell, you know, for the stock. It's either buy on margin or sell short for the stock. It's either buy or write, puts and calls, and it's the exact same trades for the exchange traded funds. So you could have, you know, potentially, you know, eight trades, potentially just from the stocks and the ETFs. If you want to throw in indexes, you can calculate those too. You could have up to 12. So how many trades would you recommend to your client and or your trading division? And then I was asking you, like we did earlier, what are some other stocks you're tracking, you're researching? And we talked about Tesla, we talked about Disney, we talked about Apple. If you list some of those, that would be great. And then if you wanted to just list, you know, maybe 5 stocks that you're interested in, and then give me a percentage in which you think, if you were to manage a portfolio of those 5 stocks, how would you weight them within the portfolio?
What are the percentages go?
You know, how much of your portfolio would be Apple? How much would be Tesla? How much would be Disney? How much would be Google? Because now what we're talking about is building portfolios, and then the question then becomes, what is your long-term expected rate of return on that portfolio? So if you had Apple, Tesla, Google, Disney, and maybe Oracle in your portfolio, how much return do you think that you would get? How much return would you expect to get from that portfolio? What?
So it was like percentage based, correct?
Yeah, what would be your expected return over the long run?
15.
Yeah, probably. I mean,
At least.
you all are pretty active traders, you're young, you're using some high-tech companies that are some fairly rapidly growing companies, so your portfolio return expectations would be pretty high. So yeah, what did you say?
15.
Yeah, probably 15%. Because 8 to 10 is pretty much the index. So by putting your money and allocating them in these higher growth rate stocks, you're gonna expect a higher rate of return. So I wanna just see if you can think through and know about some stocks, and then give percentages and then guesstimate what your expected return would be based off those allocations. Okay. So if you can do this, you're in really, really good shape. You pretty much have everything in the bag.
For those stocks that we list, do you want us to have like approximate stock values?
You know, I'm not really even worried about that.
Okay.
I'm worried, what I'm really trying to get you to do is to identify some stocks that you would invest in, and then figure out the allocation to build a portfolio, and then what you think that your portfolio would do over the long run. And you're probably gonna be pretty close to being right, because you know it's not 5%, and you know it's not 50. So it's gotta be somewhere in between like 10 and 20, basically. Okay, any questions on this? Fairly straightforward, can you do it?
I think so.
Yeah, the answer is yes. The answer is yes, because they're gonna ask you, can you do this stuff? And you're gonna say, what?
Yes.
Yes, exactly. Yeah. Yeah, and even if you can't do it, you say, no, I can figure this stuff out. I can figure this out, I can do this. All right. So how much time do we have?
35.
Half hour.
About a half hour. Okay, I'll see how fast I can get through these slides. I'm just gonna go very high level on these things.
What chapters are you going through right now?
I'm going through the, hold on a second. I'll tell you. So I'm gonna go through, and I already posted the edited versions up there, so I'm gonna go through 10, 11, 12, 13, 14, 15, 16, 17. So I'll go pretty quickly, just hitting on very high level stuff.
This is chapter 10.
Yeah, it's 10 through 17 is the midterm. And again, I'm just gonna hit on really high takeaways, because a lot of the stuff we already went through, either in class or conceptually. So chapter 10 focuses on capital budgeting, and the discounted cash flow approach you can use for multiple types of capital budgeting decision. Do we buy this piece of equipment? How much cash flow is it going to produce over time? What's the salvage value at the end? And what's the internal rate of return in the NPV? Okay. So you can use discounted cash flow analyses or capital budgeting to basically look at, do we put some money into this property, keep it, we're plowing more money into it, and we can fix it up and get more rent? What is our internal rate of return on that investment? So renewal, replacement, we need we need all new, heating, ventilation, and air conditioning, in this property. How much is it gonna cost to buy all that equipment? What's the savings in energy we're gonna get over the next 10, 15 years, net of depreciation, because we're gonna add back the cash. And then we're gonna run a net present value and an internal rate of return to see if we should implement the new HVAC equipment. And it could be manufacturing equipment, could be anything. Expansion, do we add a new facility? Do we add more equipment on the margin to be able to increase production? How much is it gonna cost us to build real estate? How much revenue are we gonna get from the space? Does it make sense for us to expand more equipment or expand the space? So that's, and you use MPV and IRR analysis and regulatory analysis. So the assumption is when you're looking at these capital projects that they're independent and they're mutually exclusive. They may be contingent upon each other, but in those cases, your assumption is they're mutually exclusive. And then you're gonna pick, maybe you run 3 projects or 3 scenarios, and you're gonna pick the project that's gonna give you the highest net present value or highest internal rate of return. There may be 3 projects that are mutually exclusive, 2 have negative NPVs, one's positive, you pick the one with positive net present value. And the assumption is that your capital is extremely precious. It's gonna cost you money to be able to deploy this capital, and the cost of that capital is gonna be your weighted average cost of capital. How much does it cost for us to gain access to the bond market and the stock market, our cost of the debt and our cost of the equity? And we're gonna calculate a weighted average cost of capital, and that's what we're gonna apply to the cash flows to get the NPV and the IRR. So we already talked about net present value. We understand that it's the net cash flows, cash inflows, cash outflows. You use the net to be able to discount back to the present to get the present value. If the present value is higher than the cost of deployment, then you accept the project. If the net present value is positive, you accept it. If the internal rate of return is greater than your expected return or your cost of capital, you accept it. And this is just a basic NPV calculation, and here's an example of a piece of equipment that you purchased. You have net cash flows, and then you have a salvage value on the end. You discount those back, and in this case, the NPV is negative. So we're gonna have to get at least a reduction in the cost of the equipment, or we're gonna have to get higher cash flows or higher salvage value at the end of the period to make it work. And if the NPV is 0, what's the internal rate of return in this example? If the net present value is 0, what's your internal rate of return in this example?
100.
No, the internal rate of return, the IRR. If the net present value is equal to 0, what's the internal rate of return? It's 15%. When the net present value is 0, your internal rate of return is your expected return. So you can very quickly know that if the net present value is negative, then your IRR is less than your expected return. If the net present value is positive, it's going to be higher than your expected return. If the net present value is 0, it's equal to your expected return. Okay. And you can calculate the present values using the financial calculator. And if you know the present value, you can also calculate the internal rate of return. And you can also use, I may spend a little time on Wednesday showing you some of the Excel spreadsheets. And I will make those available to you. So you have them, so you have the cash flow statements that you can use for your other classes too. Okay, and then we've already gone through the decision trees. And I don't think I asked you in, on the midterm, did I ask you to do the valuation matrix? The valuation matrix?
No.
Present value greater than price, present value equal to price, present value less than price.
No.
Net present value positive, net present value equal, so you go through those 4 iterations. I'll probably put that in there because you need to memorize that. Okay, but that should be pretty quick. And then you have payback period. Again, very quickly you can figure out what the cash flows are. So you can subtract it, and you can figure out very quickly what your break-even point is, how long it's going to take for us to break even from the cash flows that are coming in. So you're just subtracting the cash flows from your cost or your acquisition price, and how long does it take to burn through the cost or the acquisition price to get break even. And again, in most startup companies and most metrics are less than 3 years. For real estate, it's 5 years. Tech companies, it's 3 years. For established investments, it's 3 years, and for tech companies, they want to be paid in less than a year in most cases, or a year and a half, which is extremely aggressive. So payback period, remember if it's greater than, in our case, if it's greater than 5 years, you'd probably reject the project. If it's equal to 5, you'd accept it. If it's less than 5, you'd accept it. You can also discount back the cash flows. You get a break even based on the discounted cash flows. So you can use gross cash flows, or you can discount the cash flows into the future to calculate the break even. So it depends on how aggressive you want to be. So usually we use gross, but again, if you want to assume some risk, then you would apply the discount factors and do the discounted cash flows and look at the break even, which would be more conservative. When do we get paid back based on some kind of discounted cash flows? Because we're assuming very high risk in those cash flows in the future. And then the accounting rate of return is just an income return. What is my average net income divided by the book value? So this is just an income return. And this would be a benchmark. A lot of firms will say we need at least 5 to 10% income return or accounting rate of return, or we need to reach a certain hurdle rate in accounting rate of return by some period to accept the project. So again, it's just another way of evaluating the returns. But in this case, it's an income return based on the book value. And then the IRR, we talked about it, when the net present value is 0. Your internal rate of return is your discount rate. And you really do need to use a calculator, and you really do need to use a spreadsheet to get to the IRRs. And you can, in Excel, you can use the equal IRR macro to be able to do the calculation of the cash flows. And again, if you know the assumptions, you can get the internal rate of return from the financial calculator, or you can run it through on the spreadsheet. And again, you can see as the discount rate increases, at some point, your net present value is turned negative. So the higher your discount rate, at some point, your net present value is going to turn negative. And again, if your IRR is greater than your cost of capital or your expected rate of return or your discount rate, they're all basically the same thing, you're going to accept the project. And then the modified internal rate of return is a way of calculating present values, internal rates of return on reinvested capital. Internal rate of return is the standard. You can use modified internal rate of return, which means you grow out the cash flows to the terminal period in the last year, the holding period, and then discount that back to the present. So what you're doing is the cash flows are being reinvested over time. So it's like a zero coupon bond. And again, you get an MIRR from that. And then profitability indexes are very useful too. You have the present value of the cash flows divided by the initial investment, or the NPV plus the initial investment divided by the initial investment. And what that gives you is a profitability index that then you can rank projects and either select them based on how high the profitability indexes are, or you know to do project A first and project B because of the profitability indexes that you're getting. And then the methodologies, and this kind of gets back to what we were been talking about, that 75% of the time, people are using internal rates of return in their decision-making methodologies when they're using discounted cash flow. 76% of the time they use internal rate of return, 75% of the time net present value. So these are basically the two main methodologies. then the payback, then the accounting rate of return. So these are what they use to make decisions based on capital budgeting for projects. Cash flow analysis. When you're looking at projects that are generating cash flows, you want to look at the contribution of the free cash flows with and without the project. So it's really incremental contributions to cash flows. So every time you buy a company, every time you buy a project, what is the incremental contribution to the cash flows that that project or that company is generating for the overall firm? So you're really looking at it on the margin. In the free cash flows, revenues minus expenses, minus depreciation, amortization, net of tax, add back depreciation, amortization. Capital expenditures, I usually don't include these because it really distorts the free cash flows. And then additional working capital in most cases is immaterial. So these are really the most important in determining free cash flows for analysis. So here's your basic income statement. You're taking out the expenses, EBITDA, this is what we mainly use for valuation purposes for small companies. Take out the depreciation amortization, you got EBIT, take out the tax rate, net operating profit after tax, add back the depreciation, cash flow from operations, and then I could do the valuations here too. And usually CapEx and additional working capital, again, would be distorted. And then here's your typical spreadsheet with the assumptions, projecting out the cash flows and the expenses, taking out depreciation, getting EBIT, that's the taxes, net operating income, and then adding back the depreciation to get cash flows from operations. And then again, I wouldn't even include these. And then you can calculate the net present value. It's missing the internal rate of return. What you also do is you will divide these cash flows here by the book values to get the accounting rates of return, the profitability indexes. So what we like to do is to divide these by the book values to see at what point in time do we hit the income return hurdle rates. So this spreadsheet's missing some stuff.
And why is it that the last year has an extra $1,000 for the free cash flow?
A minus, free cash flow.
Yes.
I don't know, I gotta look at the, this example. It's probably something at the end, something reverts in the last year, the holding period. So when you're looking at cash flows, and this is why I would take out the capital budgetings, because you ignore in most cases the sum costs. And you only, in some cases, you can analyze and look at after-tax cash flows. The analysis that we were looking at were nominal cash flows. In most cases, you're going to use nominal cash flows. Cash flows, you're not going to use discounted real. Discounting the cash flows by the inflation rate, you're going to use nominal. And it really doesn't matter because they both basically give you the same outcomes. So here's an example of a cash flow. So what you would do, if this was a real cash flow, this is nominal, this was real, you would adjust these by the inflation rate, and you would also use the real rate, not the nominal rate, because the nominal rate includes inflation expectations in here. So you get to real cash flows with a real rate of return. And you can calculate the real rate of you know what the nominal is, and let's say the inflation rate is 5%, you can discount that and get a real rate of return. So assuming a 5% inflation rate and a 15% nominal return, you would divide the 1.15 by the 1.05 to get a real rate, minus 1 to get a real rate. So some people want to see, you know, what's my nominal return, but also what's my inflation adjusted, what's my real. And here's the example of the real. You're discounting it by the inflation rate. You get the cash flows divided by the real rates of return, you get a real MPV. In this case, it's positive, not negative. And then taxation, income taxes, progressive, and then it turns into a flat tax at some point. This does not include alternative minimum tax or state taxes. And then corporate income taxes, again, same type of progressive tax systems that eventually turn flat, but there's a lot of, you know, deductions, you know, expenses and credits and other things that are added back. And then when you're calculating the tax rates, you're using accelerated cost recovery systems. So there's two books that you have. You have the GAAP accounting books, and then you have your tax books, and they're under two different depreciation schedules. Just gonna fast forward through this. You can also look at what are called equivalent annual costs. You want to look at different projects with different lives, so you can adjust those to take into consideration the different lives. So this is a 3-year life asset, and this is a 2-year life. The first one costs $250,000. It's going to last for 2 years, and this one's $360,000 and expected to last 3 years, and the cost of capital is 10% this year. So you can create an adjustment that adjusts the cash flows to be able to compare them over different lives. So it's really here is the 1.01 squared, 1.01 squared minus 1, and that creates an adjustment factor for the life. And then the key, when you're holding assets, let's say you buy a piece of real estate or you buy a company, the key here is when do you sell it? When do you exit? What's the exit rule? And this is probably the most important right here. Is the optimal time to harvest or cash in investments is when the rate of increase in the asset's nominal net present value equals your cost of capital or your expected rate of return. So when the rate of the MPV, the growth rate in the net present value, equals your expected return, that's the point in which you sell the asset. So when your rate of return, or sorry, your growth rate in the net present value equals your expected return, that's when you sell the asset. When you're looking at costs, there's really two types of production environments in which you work in. One is an automated environment and the other is a manual environment. So very labor intensive and then capital intensive. You mostly use labor, or you have a lot of equipment and you've spent a lot of money on equipment. And in this case, your fixed cost in an automated environment is 35,000, where capital in a labor intensive is only 4,000. And you get depreciation amortization of 10,000, where you only get 1,000 in the manual. So it makes sense to deploy manual up to a point when the demand for your product really kicks in, then you need to invest in capital. What you're looking at is your EBITDA, revenue minus operating expenses. And your operating expenses are your fixed, or your variable costs and your fixed costs. And really your break even is gonna come in from here. So this is the cost of the equipment right here. So in this case, you have both units sold at 10,000 under the automated and the manual. In this case, your cash flow is 55,000 compared to 46,000 under a 10,000 unit production. But when the production drops in the automated environment to 8,000, or 10,000 to 8,000 under manual, as you can see, the percentage change to your free cash flow is severely impacted in the automated environment because you have all that fixed cost. Where your labor in a manual environment can handle it because your labor costs are variable costs. So it's really the capital costs, fixed cost is what really impairs the free cash flow. Because you have so much money sunk into the capital. So there's a point in which you're going to use labor, and then there's a point in which you're going to switch to capital intensive. So there's a crossover point. And again, here, another good example when you see the reduction in the demand for the units, you can see how hard hit the automated environment is compared to the labor environment. And again, it's because of the fixed costs, due to the sunk cost of the equipment.
And this is just in terms of monetary, this isn't in terms of ethics or
No, this
the
is just,
surrounding area.
no, this is just, you usually start with manual production, and then as the demand grows, you invest in equipment to be able to produce at a higher rate. And because of the ability to scale up rapidly, your net operating income growth rate actually switches. If this went from 10 to 20,000, this would be higher than this. But labor allows you to adjust down because the labor costs are variable. The fixed costs are what really impairs the free cash flow growth rates. And you can model these out in Excel too. So the question really is how much capital, how much operating leverage do you have? And the operating leverage is dependent on the fixed costs divided by your pre-tax operating cash flow. That's going to give you the leverage from your capital. And in this case, your capital is 1.6 times. So production really scales up, the capital leverage kicks in, and your free cash flow growth rates take off. Because you're using the capital, the equipment to really leverage. Because at the end, when production goes up, your total costs start to drop significantly as the economies of scale set in. And degree of accounting operating leverage is basically saying that your charges divided by your operating profits. And then your accounting leverage, as you can see, is 2 times. It's a very high leverage due to capital deployment. So you want to be able to calculate break even, which is going to be your fixed costs divided by the price in which you sell it for and the variable costs. And at some point you're going to reach break even. The break even is higher for automated and lower for labor. But again, remember, if you have really high demand, you're going to break through the break even on the automated, and then your free cash flow is gonna be levered up due to the equipment. And here's an example of the break even. For the labor, it's 800 units, and for automated, it's 4,000. So there's some point in which you have to shift from labor over to equipment. And then we talked about earlier, when you're varying the discount rates and growth rates and terminal values, you're doing sensitivity analysis. And then when you're doing the different weightings of the valuation methods, like we talked about, you're using scenario analysis. And then what you may end up doing, depending on your major, is probably going to simulation. Maybe you don't have enough data points, but you do have a sample. What you can do is you can select data from the sample and replicate it 1,000, 2,000 times and basically manufacture data sets using simulation analysis.
Five minutes.
Thank you. Cost of capital. Firms use their weighted average cost of capital as the discount rates for acquisitions of companies and to purchase equipment or purchase other firms. So your weighted average cost of capital is really your hurdle rate. It's your minimum expected rate of return that you need on the margin to be able to accept the project. So you can calculate the weights by looking at the book values or the market values of your equity and your liabilities. So if you know what the total market value of the assets, you can calculate the weight of the liabilities and you can calculate the weight of the equity and use those as the weights to calculate the weighted average cost of capital. So as we talked about earlier, using the risk premium approach, you can calculate the weighted average cost of capital. If you know what the weights are, and you know what the cost of capital are, you can calculate the cost of the capital for the firm. So you have the cost of the debt times the debt, the cost of the equity times the value of the equity, either in market value or book value, to get the weighted average cost of capital for the firm or the discount rate that you're going to use to apply. And here's an example of the weights, but I think we already went over that. When you're calculating the cost of the debt, and again, you can use the risk premium approach, risk-free rate plus the risk premiums to get the cost of the debt, or the yield to maturity on the debt, and you take out and adjust for the tax shield because the interest on the bonds are tax deductible. The cost of the equity, you're going to use the capital asset pricing model, which we know is the risk-free rate plus the beta times the return on the market minus the risk-free rate. That goes up or that goes up or that goes up, your cost of equity goes up. Discount rates go up, your values go down. Constant growth rate, this is the Gordon growth model. You can also estimate the cost of the equity by taking the dividends or the earnings per share divided by the stock price, plus the constant growth rate, which you assume in Gordon growth to get a proxy cost. Of equity, you can do it like that too. Here's your terminal value there. And you can also do the calculations in the spreadsheet. The cost of the preferred stock, it's the dividends on the preferred stock divided by the preferred stock price. And again, dividends on preferred stock, they don't grow at a constant rate, they're flat forever. So when you buy a preferred stock, it's forever. So you will get that payout, you will get that dividend, it will be flat forever, so you use the perpetuity model. And then your weighted average cost of capital is gonna be the weighted cost of the debt, taking out the tax shield, the weight of the preferred times the cost of the preferred, and the weight of the common times the cost of the commons using CAPM. And then again, you can use these to be able to accept or reject projects depending on how risky they are. Are we out of time?
A minute.
Got a minute. Why don't we do 14, 15, 16, 17 on Wednesday? So you can blow through those, but then we'll do the problems. So bring some problems for Wednesday.